Well, I think it's important to sift through what's real and what isn't real, what maybe try to get some glasses to look in the future and figure out what's going to happen and then figure out what happened yesterday. So that's a lot to throw at you. But let's start with the trade war. First of all, China needs us more than we need them. Time is the enemy for them. We can replace them and suppliers with Vietnam, Taiwan, Thailand, India, all these different countries, and they're all itching to do so. So China can't replace the U.S., but we can replace them. That's a big deal. They were at the finish line. They were close to the finish line, and they wrongly interpreted Trump's discussion about the economy and the Fed needing to lower rates as a sign of weakness. And by doing that, they were emboldened and thought they could come in and just renege on what the terms they had as far as changing their laws on intellectual property rights.
Dory, listen, we've all got stuff that's now made in Cambodia that used to be made in China a couple of years ago. But that could take years and cost U.S. companies a lot of money as they reset their supply chains, which means that could go directly to earnings, not even withstanding the higher tariffs that may be coming. Doesn't that mean we need to ratchet down earnings expectations, and thus the market multiples must come down and stock prices must come down?
Well, let's just do some simple math. China retaliates on $60 billion worth of goods yesterday. We had started out on $200 billion worth of goods, the tariffs. Does that equate to a $1.1 trillion loss in the market yesterday? No, not at all. The best calculation I've seen is the effect of all this is probably maybe 50 basis points on GDP. Heck, the last number that came out on GDP was more than 50 basis points, surprise to the upside. So I think there's plenty of room to work here. And the way I look at the market yesterday is what started out as bad news turned it out into a trade unwind, much like the end of the year in 2018. So everything's on sale. So it's a great time to go out shopping in the market and buy a bunch of stocks that shouldn't have gone down, particularly in different sectors.
Well, why do you say they shouldn't have gone down? The market is its own master.
Well, that's true. But if you look at a lot of these, like in the banking sector, look in regional banks or community banks that have really relatively no exposure to China, certainly directly, and very difficult indirectly. They were down the same amount as some of these big S&P 500 companies or a Citigroup that's got exposure worldwide. So there's no reason for a lot of those banks to go down to single-digit PEs when they don't have the exposure.
Listen, December, Dory, wasn't that long ago. I guess maybe some of the concerns out there we saw indiscriminate selling yesterday was that all these, and I don't want to bring up bad memories of the past, all these low volatility strategies that kind of reared their ugly heads in December, all people buying low vol products and these ETFs and whatever, sent the market crashing in December. Do you worry those trades have been put back on and this market is susceptible to a December-like quick swoon?
Absolutely. And I think that's what started to happen yesterday. And it could continue to happen in the next few days. So as this turns into more of a technical market versus a fundamental market, that creates great buying opportunities.